So, $53 billion. That's how much U.S. bank stocks lost in a single trading session today, the worst day for American banking stocks in over 3 years. And here's the chain of events that caused it. Donald Trump's tariffs triggered Canada's most aggressive financial retaliation in history. Mark Carney's government blocked U.S. banks from operating in Canada. J.P. Morgan, Goldman Sachs, Bank of America, Morgan Stanley, Citigroup, Wells Fargo, all of them cut off from the 9th largest economy in the world. The market responded by wiping $53 billion off their combined market value before the closing bell. Warren Buffett, whose Berkshire Hathaway lost an estimated $1.5 billion on its bank stock holdings today alone, issued a statement tonight unlike anything I've seen in 50 years of public life. When the world's greatest investor loses $1.5 billion in a single day because of a trade policy, and then tells you exactly whose fault it is, you need to hear what he said. If you own bank stocks in your portfolio, your retirement account, your 401k, or your index fund, you lost money today. If you hold any financial sector ETF, you lost money today. The KBW Bank Index had its worst session since the regional banking crisis. Credit default swaps widened, and the VIX index spiked 18%. After-hours trading suggests tomorrow might be worse. Let me walk you through what Canada did. The directive itself took less than 30 seconds to read, but took about 7 hours to fully detonate on Wall Street. At 7 a.m. Eastern, Canada's Office of the Superintendent of Financial Institutions, OSFI, the regulatory body overseeing all banking activity in Canada, issued an emergency directive suspending the full-service operating licenses of all U.S.-headquartered banks with Canadian subsidiaries. 6 major banks, J.P. Morgan Chase, Goldman Sachs, Morgan Stanley, Bank of America, Citigroup, and Wells Fargo, were directly affected. The suspension meant no new investment banking deals, no new wealth management clients, no new capital markets activity, and no new M&A advisory mandates in Canada. Existing positions were to be wound down over 180 days, after which the doors closed completely. In plain English, Canada just told the 6 most powerful banks on earth that they are no longer welcome to do business in the 9th largest economy in the world. The timing was deliberate. The 7 a.m. Eastern release gave the news exactly 2.5 hours to propagate through every Bloomberg terminal, every trading desk, and every risk management system on Wall Street before the opening bell. By 8 a.m., every portfolio manager with bank stock exposure had called their risk officer. By 8:30, risk officers had called compliance. By 9 o'clock, compliance had called legal. By 9:25, 5 minutes before the market opened, sell orders were already stacked so deep that the opening was going to be a massacre. OSFI cited reciprocal financial sovereignty measures, a direct response to U.S. Treasury restrictions on Canadian financial institutions and the broader tariff escalation that has defined the past several months of the trade war. Carney's public statement was measured and devastating in its calm. Canada has always supported open financial markets, but open markets require mutual respect. When that respect is absent, we adjust our exposure accordingly. The word adjust framed the most aggressive financial retaliation a G7 nation has ever taken against another G7 nation's banking system as a simple rational recalibration. Not anger, not revenge, an adjustment. The diplomatic restraint made it harder for Washington to respond with escalation because there was nothing inflammatory to react to. Just a policy, just a directive, just the end of Wall Street's access to $1 trillion financial market. Here's the insight that explains why the market crashed $53 billion instead of the $15 billion or so that the Canadian revenue loss alone would justify. U.S. banks earn an estimated $14.8 billion annually from Canadian operations, investment banking fees, wealth management for high-net-worth Canadian clients, and asset management for Canadian pension funds holding over $1.4 trillion in assets. To put that in perspective, the Canada Pension Plan Investment Board manages $570 billion alone, the Ontario Teachers Pension Plan manages $250 billion, and the Caisse de dépôt et placement du Québec manages $420 billion. These are among the most sophisticated and coveted institutional clients in global finance, and U.S. banks have managed significant portions of their portfolios for decades. Add M&A advisory on Canada's $180 to $220 billion annual deal pipeline, capital markets trading on the Toronto Stock Exchange, and commodity trading in energy, minerals, and agriculture, and you get $14.8 billion in annual revenue. A number the size of a Fortune 500 company gone in a single directive. But the loss of $14.8 billion in annual revenue would normally produce a 1 to 1.5% decline in bank stocks. The market didn't drop 1%, it dropped 3 to 4%. It dropped $53 billion.
Why?
Because the market didn't just price in the loss of Canadian revenue, it priced in something much bigger, the demonstration that a G7 ally, America's closest neighbor and largest trading partner, a country that shares the world's longest undefended border, can lock American banks out of its financial system with a single regulatory directive. That's not just a Canada problem, that's a structural problem. If Canada can do it, the European Union can do it, the United Kingdom can do it, Japan can do it, Australia can do it. The market, in its cold and efficient way, priced in the probability that at least some of them will. The $53 billion wasn't about Canada, it was about what Canada proved is possible. Once the market understands that a risk exists, it prices that risk into every share, bond, and derivative immediately and permanently. Let me walk you through the trading day. Here's how $53 billion disappears in 7 hours. At 7 a.m., when the OSFI directive hit the newswires, bank stock pre-market trading activated within minutes. J.P. Morgan, which had closed the day before at $222 per share, showed pre-market bids at $215. Goldman Sachs, which had closed at $496, showed bids at $480. Bank of America, which had closed at $295.50, showed bids at $28.80. Nasdaq futures dropped 0.5%. CNBC broke into regular programming with a breaking news banner. Bloomberg's Terminal Alert System, the messaging platform that connects every institutional investor on Earth, lit up with red headlines and urgent commentary. The futures market, the market that trades around the clock and reacts first to overnight developments, had already delivered its verdict before most Americans finished their morning coffee. Trading desk phones started ringing over Lower Manhattan. Portfolio managers were calling risk officers were calling compliance, and compliance was calling legal. Legal then contacted outside counsel to figure out what OSFI's directive actually meant for their Canadian operations. By 9 a.m., every trading desk on Wall Street knew what was coming. Sell orders were already stacking up in the exchange's pre-open queue, visible to anyone with a Level 2 market data terminal. The ratio of sell orders to buy orders was running 4-to-1 on major bank stocks. At 9:30 a.m., the opening bell rang. The opening cross, the mechanism that matches buy and sell orders when the market opens each day, was massively imbalanced. For every buyer of J.P. Morgan stock, there were approximately 4 sellers. J.P. Morgan opened at $213, a $9 gap down from its previous close of $222. That single opening tick wiped approximately $16 billion in market cap, $16 billion gone in the blink of an eye. Goldman opened at $478, down $18 from the previous close. Bank of America opened at $28.40. Wells Fargo, Morgan Stanley, and Citigroup all gapped down between 2% and 4% at the open. The opening bell wasn't just a bell today, it was a starting gun for a selling stampede. Between 9:30 and 10:30 a.m., the first wave hit, and it wasn't human. Quantitative trading algorithms, the computer programs that now account for over 60% of daily U.S. stock market volume, activated their sell protocols. These algorithms don't panic. They don't hesitate. They don't call their spouse to ask if this is the right move. They execute. When hundreds of algorithms all execute sell orders on the same 6 stocks within a 10-minute window, the selling pressure overwhelms the available buyers. The bid side of the order book evaporated. Market makers widened their spreads to protect themselves. The price fell, which triggered more algorithmic selling, pushing prices even lower. By 10:30 a.m., 1 hour after the open, the combined bank stock loss had already exceeded $30 billion, and human selling hadn't even fully begun. Between 10:30 and noon, the contagion spread. Bank stock crashes began bleeding into the broader financial sector. Regional banks, PNC, U.S. Bank, Trust, M&T Bank, none directly affected by the Canada bloc, all fell between 1.5% and 2.5% on contagion fears. The market logic was simple and terrifying. If Canada can block J.P. Morgan, what stops other countries from blocking American banks? Insurance stocks fell on counterparty exposure to the affected banks. The KBW Bank Index, the benchmark tracking U.S. banking stocks, hit its worst intraday decline in over 3 years. Credit default swaps on U.S. bank debt widened significantly, meaning the cost of insuring against a bank default increased in real time. The VIX, the volatility index traders call the fear gauge, spiked 18% in a single session. By noon, it wasn't just a bank stock problem. The financial sector was bleeding into every sector with international exposure. Technology companies with Canadian operations fell 0.8%. Energy companies with Canadian partnerships fell 1.2%. Industrials with cross-border supply chains fell almost a full point. The market read Canada's bank bloc as a signal that the trade war had entered the financial system. And when the trade war enters the financial system, nothing is safe. Between 1 o'clock and 3 p.m., the margin calls arrived. Investors who had bought bank stocks on margin using borrowed money received demands to either deposit additional cash immediately or sell positions to cover their shortfall. A margin call is forced selling. It's not a choice. When your positions lose enough value that your broker requires more collateral, you either wire money or the broker sells your stock for you. Forced selling doesn't negotiate. It doesn't wait for a better price. It hits whatever bid is available. Margin calls push selling into a feedback loop, falling prices triggering margin calls, triggering more selling. Triggering lower prices, margin calls escalated. JP Morgan broke below $210, its lowest level in 14 months. Stop-loss orders clustered at $210. Automatic sell orders placed by investors who had pre-decided that $210 was their pain threshold fired in sequence, adding more sell volume to a market already drowning in it. Goldman Sachs briefly touched a circuit breaker threshold, the point at which a stock has fallen nearly 10% from the previous close, and the exchange halts trading for 5 minutes to allow the market to stabilize. Goldman recovered just enough to avoid an actual halt, but the near trigger sent a chill through every trading floor on the street. A circuit breaker on Goldman Sachs, that's not a headline traders expect on a Tuesday, and the final 30 minutes, bargain hunters stepped in. Short sellers who had profited from the decline began buying to lock in gains. Value investors, watching the carnage, saw opportunity in bank stocks at 14-month lows. The buying provided a modest bounce, enough to bring losses back from their worst levels, but nowhere near enough to repair the damage. The final tally at the closing bell, JP Morgan Chase down 4.2%, $24.4 billion in market cap destroyed. Bank of America down 3.8%, $11.8 billion gone. Wells Fargo down 3.1%, $6 billion lost. Goldman Sachs down 3.5%, $5.1 billion erased. Morgan Stanley down 2.9%, $4.1 billion wiped. Citigroup down 1.7%, $2 billion vanished. Combined, $53.4 billion in U.S. bank market capitalization destroyed in one trading session. The KBW Bank Index closed down 3.7%, its worst single day since the regional banking crisis of March 2023, and after-hours trading continued the decline. Futures indicated tomorrow's open could be lower still. Each of the 6 banks has its own story behind the carnage. JP Morgan took the hardest hit, $24.4 billion, because it had the most to lose. JP Morgan is the largest U.S. bank presence in Canada, earning approximately $3.9 billion annually from Canadian operations and acting as lead advisor on 3 active Canadian M&A transactions worth over $10 billion each, now all in jeopardy. Jamie Dimon issued a statement calling the Canadian action unprecedented and deeply concerning. But JP Morgan didn't just lose Canadian revenue, it lost the assumption that its global footprint was invulnerable to Allied retaliation. That assumption, it turns out, was worth more than the revenue itself. Bank of America lost $11.8 billion, going beyond its $2.1 billion Canadian revenue exposure. Bank of America is the Buffett stock. Berkshire Hathaway holds approximately $33 billion in BOFA shares, its largest individual stockholding by value. When news broke that Buffett's biggest bank position was directly affected by the Canada bloc, institutional investors sold not just on fundamentals, but on uncertainty. What will Buffett do? Will he add to the position? Will he start selling? The uncertainty about the most followed investor on earth added a risk premium far beyond the operational loss. Goldman Sachs lost $5.1 billion and briefly touched its circuit breaker threshold, the single most alarming moment of the trading day. Goldman's Canadian exposure is concentrated in the highest margin business, M&A advisory and investment banking. Goldman was advising on the largest pending Canadian deal, a $14 billion energy sector consolidation, representing one of its biggest single advisory fees globally. The Canada bloc means Goldman can no longer legally advise on that deal. Canadian banks, RBC Capital Markets, TD Securities, Capital Markets, are already circling to replace Goldman as lead advisor. And they're circling on every active mandate U.S. banks can no longer service. Bay Street is ready to absorb what Wall Street just lost. The transfer is already happening in real time. The remaining 3 banks, Wells Fargo down $6 billion, Morgan Stanley down $4.1 billion, Citigroup down $2 billion, each suffered from their own vulnerabilities. Wells Fargo's Canadian commercial banking and real estate finance exposure compounded domestic regulatory pressure. Morgan Stanley's wealth management relationships with Canada's wealthiest families were legally severed. Citigroup's role in cross-border trade finance and payment infrastructure was disrupted far beyond the headline numbers. 6 banks, 6 different stories, one common theme. Nobody on Wall Street priced in that America's closest ally would lock them out of its financial system. Today, they're all repricing. That brings us to the man who lost $1.5 billion of his shareholders' money before lunch. Warren Buffett released a formal statement tonight, significant in itself, because Buffett almost never comments on single-day market events. He's the most patient investor alive. He doesn't react to daily noise. He spent 60 years telling people to ignore short-term fluctuations and focus on long-term value. The fact he issued a statement about today's crash shows how seriously he takes what happened. Berkshire Hathaway holds approximately $33 billion in Bank of America stock, $3.5 billion in Citigroup, and several billion more in other financial sector positions. Today, Berkshire lost an estimated $1.5 billion on those holdings alone. When Buffett speaks about the $53 billion crash, he isn't on the sidelines. He isn't offering academic commentary. He's speaking from inside the wreckage. The market isn't wrong, Buffett said. The market is doing what it always does, repricing risk based on new information. The new information is that a G7 ally demonstrated U.S. banks have a geopolitical vulnerability nobody priced in. A single regulatory directive from an allied nation can lock American banks out of a major economy. That risk premium will now be permanently embedded in U.S. bank valuations. Buffett continued, "I've been investing in American banks for decades because I believed in two things: the strength of the American financial system and the reliability of the American regulatory environment. Today, both took a $53 billion hit. That's Buffett telling you, the market isn't overreacting. The market is correct. The $53 billion isn't panic. It's a rational repricing of a risk nobody accounted for until this morning." He drew the causal chain explicitly and pointed the blame directly at the tariff policy. Berkshire lost approximately $1.5 billion today on our bank holdings alone. That loss was not caused by a banking crisis, bad lending, or excessive risk-taking by the banks. It was caused by a trade policy. Our banks are being punished by the market because the government provoked a G7 ally into retaliating against our financial system. That's policy risk, the one kind of risk I cannot hedge. Then Buffett added the line that will echo through every trading floor tomorrow: when the tide goes out, you see who's swimming naked. Today's $53 billion proves American bank stocks were priced as if the tide would never go out. Well, Canada just pulled the plug on the ocean. On what comes next, Buffett was direct: it depends on what Washington does next. If the tariff policy is reversed, markets will stabilize. If the tariff policy escalates, the next country to block American banks might not be Canada. It could be the EU, the UK, or Japan. And if that happens, the $53 billion we lost today will look like a warm-up. He confirmed he is not selling his Bank of America position, but added a qualifier that rattled institutional investors: the thesis that justified American banks as the safest, most reliable financial institutions took structural damage today, damage that cannot be repaired by one good earnings report. This is structural. A Berkshire board member described the mood. Warren was calm, as always, but there was a sharpness to it. We just lost $1.5 billion because a tariff triggered a retaliation that nobody in Washington thought through. I'd like someone in the White House to explain to my shareholders why that was a good trade. Then he paused and added, I suspect I'll be waiting a long time for that explanation. When the Oracle of Omaha tells his shareholders that the American banking thesis took structural damage, the foundational investment thesis underwriting the global financial system for 80 years, that statement echoes through every pension fund, sovereign wealth fund, and family office on the planet. It's not a tweet. It's not an opinion. It's a $130 billion investor telling the world, I'm worried. And when Buffett is worried, everyone else should be terrified. The $53 billion impact goes beyond bank stocks. The contagion is already spreading. The S&P 500 closed down 1.4%, losing approximately $560 billion in total market value. The financial sector's weight in the index dragged everything lower, but the contagion went further. Every sector with significant international exposure fell. Technology companies with Canadian operations dropped nearly 1%. Energy companies with Canadian partnerships fell 1.2%. Industrials with cross-border supply chains fell almost a full point. The market read Canada's bank bloc as a signal that the trade war had entered the financial system. When the trade war enters the financial system, the repricing doesn't stop at bank stocks. European bank stocks fell 0.5% to a full percent in sympathy trading. Asian markets, opened during the U.S. afternoon session, showed losses as the news rippled across the Pacific. The $53 billion loss on Wall Street triggered an estimated $80 to $100 billion in additional global market losses before most of the world had gone to sleep. For the average American, the damage is personal and immediate. The S&P 500's 1.4% decline translates directly into retirement accounts. With an average 401k balance of approximately $112,000, a 1.4% to 4% decline meant roughly $1,500 loss today, not because of a recession, pandemic, or banking recklessness, but because a tariff triggered a retaliation that crashed bank stocks and dragged the entire market down. For Americans closer to retirement, the losses are proportionally larger. A 60-year-old with a $500,000 retirement account lost approximately $7,000 today, with only 5 to 7 years before needing that money. Financial advisors nationwide spent the afternoon fielding panicked calls from clients asking whether they should sell everything and move to cash. The most dangerous moment in a market crash isn't the crash itself, it's the phone call from a retiree ready to lock in losses at the bottom. If enough retail investors panic, the crash feeds on itself and the institutional credit markets, the ones retail investors rarely see. The signals were even more concerning. Credit default swaps on major U.S. bank debt widened significantly, meaning the cost of insuring against a bank default increased in real time. Bank bond yields rose, and the interbank lending rate ticked upward, subtle but ominous signals that banks were slightly more cautious lending to each other, a tremor reminiscent of 2008 and 2023. Moody's and S&P both issued statements noting they are monitoring developments related to the Canada bank bloc. In rating agency language, monitoring comes before reviewing, which comes before downgrading. A credit downgrade for any of the big six banks would be catastrophic, increasing borrowing costs, reducing collateral value of bonds, and triggering thousands of derivative contract provisions. Trump responded at 4:47 p.m., 47 minutes after the closing bell. Canada will pay a heavy price for this attack on American banks. We will respond with overwhelming force. Threatening force when the market had already lost $53 billion terrifies investors. It doesn't calm them. After the statement, S&P 500 futures dropped another 0.3%. Republican senators on the Banking Committee requested an emergency briefing from the Treasury Secretary. Wall Street bank CEOs, many of whom had supported Trump's trade agenda and donated to his campaign, requested an emergency meeting at the White House, demanding an off-ramp. The political dimension is clear. The people who lost $53 billion today aren't populist voters. They're major political donors, bank executives, and shareholders who write checks to campaigns and super PACs. Right now, they're pressuring Congress and the White House to reverse the tariff policy before the next trading session. Point 3 Looming questions hang over tonight's markets. Will the Asian markets continue the sell-off? Will European markets extend the damage tomorrow? And will Washington escalate, hold steady, or reverse its policy? Markets hate unanswered questions. Here's what happened today. Trump's tariff policy provoked Canada to block U.S. bank operations. J.P. Morgan, Goldman Sachs, Bank of America, Morgan Stanley, Citigroup, and Wells Fargo were all cut off from the 9th largest economy in the world. The market responded with the worst single session for U.S. bank stocks in over 3 years. J.P. Morgan lost $24.4 billion, Bank of America $11.8 billion, Goldman Sachs $5.1 billion, and Wells Fargo, Morgan Stanley, and Citigroup combined for another $12.1 billion. $53.4 billion in total market capitalization destroyed. The broader S&P 500 lost 1.4%, roughly $560 billion in total market value. The average American 401k lost about $1,500. Credit default swaps widened. The VIX spiked 18%. Rating agencies are watching. The interbank lending rate ticked upward. Warren Buffett, whose Berkshire Hathaway lost an estimated $1.5 billion on its bank holdings today, called the tariff policy risk that I cannot hedge, and said the American banking thesis suffered structural damage that cannot be repaired by one good earnings report. Trump promised overwhelming force in response. S&P futures dropped further after his statement. Bank CEOs are demanding a White House meeting. Asian markets will open in hours, and the world watches with bated breath. 26:51 26 minutes, 51 seconds. Markets open in hours. The $53 billion is the number. But the question is what the number means. If this was a one-day, some may call this an overreaction. Markets will recover. Bank stocks will bounce. The $53 billion loss could be remembered as a cautionary anecdote. But if this was rational repricing, if the market correctly identified a permanent new risk in American bank valuations, a risk that didn't exist yesterday, exists today, and will exist every day from now on, then today is only the beginning, not the end. When Warren Buffett, the most patient investor in history, calls it structural damage, the rational repricing explanation starts to outweigh the overreaction theory. The $53 billion traces back to a tariff. That tariff was intended to strengthen America. Instead, it triggered a retaliation proving American banks are geopolitically vulnerable, crashing their stock prices, wiping out retirement savings, rattling credit markets, and prompting the world's greatest investor to issue a formal warning to shareholders. Watch the Asian market open tonight. Watch the European open tomorrow morning. Follow the S&P futures through the overnight session. Watch the credit default swaps, because institutional money watches the credit markets far more closely than the stock market. And the signals coming from credit markets should keep bank executives awake all night. Watch Trump's next move and the market's reaction. If the next statement escalates, selling resumes. If it signals conciliation, the market may stabilize. Washington's choice between these two paths will determine whether today was merely a bad day, or the first day of something much worse, because the $53 billion was lost today. Tomorrow begins a new trading session, and the market will answer the same question it faced today. Is it safe to own American bank stocks in a world where America's trade policy can trigger your largest ally to lock you out of their financial system? $53 billion. One trading session. One tariff policy. One allied nation that said enough. The tariff was supposed to be the weapon. Today, it was the wound.